That's what I wanted. Good morning once again. We are here to look at the last topic within our course unit, within our syllabus, Fundamentals of Accounting 2. I believe you have picked something from day one to date. I might not have been the very best of a teacher, but I believe somehow, somewhere, I've added a brick onto your academic lives. However, we still have a chance to mend areas that maybe appear not so convincing to us. And that chance is on Thursday. And particularly I've said we shall pay some attention. We shall do a question in manufacturing, rather incomplete records. Another question in trading, accounting for non-profit, and another question, extended one, a detailed question in manufacturing account. But today, let us start with what we prepared. Manufacturing accounts, precisely put, we at least know that when we talk about manufacturing or when we talk about production, we are simply meaning the transformation process of materials into finished goods. It is also a fact that manufacturing businesses pay attention on buying materials to produce their own goods with the intention of selling them to earn a profit. A manufacturing business, therefore, includes a manufacturing account. In other words, this business, much as it manufactures its own goods and eventually sells them off, wants to know the cost incurred during the production of those goods so that it can now make a decision on prices of selling these goods. It can also make a decision on whether continuing to manufacture is better than buying finished goods for own selling. So, to achieve that, a manufacturing account has to be prepared to help guide this business on the various costs that have been incurred during the process of manufacturing goods. That is from the process of procuring raw materials, transforming them into goods, and then making the goods ready for market. There are very many businesses that engage into manufacturing in Uganda. If I go just to the section of food products, bread and confectionaries, you see there is Intake, there is Hot Loaf, there is Chidawarime, there is Family Loaf, there is Tip Top, there is name those bread companies that you've seen or known before dealing in bread, at least you know them. Others do manufacture drinks. Crown Beverages is one of them. Century Bottling for cocoa products. Crown Beverages is for Peps. We have Nairo Breweries, those are manufacturers. We have Uganda Breweries. We have Harris International for ham products. That is still manufacturing. We even have those who venture into manufacturing clothes. For example, we have Nightil. They are known for production of, I think, bed sheets, masks, shirts, skirts. But we even have manufacturers of building products, Hima Cement, Tororo Cement, Simba Cement, Uganda Craze Limited. We have those that manufacture or engage into animal feeds. The list is also endless, and so on and so forth. So I think from that preamble, you've known what manufacturing businesses do or look like, or the examples that they kind of take on. Now, these businesses all the time produce goods by converting raw materials into finished goods. Now, that conversion process, starting with procuring these materials and then taking them into a process of transformation that now leads them to getting to be final goods or finished goods, includes or involves costs that are incurred by the manufacturing firm. And our class today is interested in understanding the various ways we can always account for such manufacturing costs for such manufacturing firms. And so we've been in position to generate financial statements for them the same way we would have generated for businesses that engage into the general trade, which is not manufacturing. So a manufacturing account is used to calculate the production cost of goods produced for the respective period. The figure is data transferred to the trading account, at least from the fundamentals of accounting one, we know what a trading account is, not so? That section where you compute sales, cost of sales up to gross profit. That is the trading account. So we begin by manufacturing account, ascertain production costs, and then transfer the costs to the trading account. Now, when you transfer them to the trading account, they replace what would have been the purchases. Because since we are not procuring, we are manufacturing, instead of talking about purchases, we now talk about production cost of finished goods. Note that a purely trading firm purchases finished goods for resale and therefore has in its trading account the purchase account. For a manufacturing business, goods are produced for sale. In its trading account, thus, is the cost of production account, which is the item that replaces the purchases account. Does that make sense? Hello, hello, hello.
Yes.
All I want is us to follow and understand. However, a manufacturing business may not, for certain reasons, produce enough goods for its sales. Some of the sales may be made out of purchases. In this case, both the purchases and the cost of production are included in the calculation of the cost of sales. So in the event that you cannot produce enough and you end up buying other goods to supplement your purchases so that you have enough for resale, then you also include on top of the trading account, on top of manufacturing account where you generate the cost of goods produced, you also include the normal purchases that like you've known them before. So we've got to classify the costs incurred in production or in manufacturing. And we are saying, unlike the wholesalers and retailers who buy goods for resale, manufacturers begin by producing the goods before they can sell them. In doing so, they perform two functions. One of them is production and the other one is selling or sales. Thus, they have to make a decisions on what is to be produced, in what quantities, and what prices they should be sold. The additional costs of manufacturing goods are included in the costs of calculating profits to be rendered in profitability. Please, we are still in class. You don't need to interrupt our class. The class is quiet and following. So, any costs that are not directly related to producing particular units of output become additional costs. And these ones are part and parcel of determination of the profits during the preparation of the income statement. All manufacturing costs must be accumulated so as to calculate the full production costs, which should be suitably classified. Okay. We are going to look at the classifications. So the whole range of costs involved in the transformation process is what is known as manufacturing costs. You can also call them total production costs. And the classification is here. First, look at the table and make a sense of it, then I explain. Since we have looked at the table, I believe we've been in position to make some little understanding. So the classifications will take two forms. We have what we call the prime costs and also what we call the manufacturing overheads or manufacturing costs. The prime costs are those that represent costs directly traceable to a particular unit of output. They include direct material, direct labor, and direct expenses. So raw materials and supplies can be clear examples of direct materials. Factory wages. Factory wages, for example, if you are paying, just take the example of production of bread. There is an amount you pay per unit of loaf that is produced. Per unit of loaf, someone who comes in the morning, maybe they are the machine men or machine operators, and you pay them on how many loaves have you produced. In other words, you pay them as cost per unit or wage per unit produced. Those ones become direct wages to producing a loaf of bread. I don't know whether we are communicating the same language. Have you seen that mode of payment, which is piece rate? You are paid depending on how much you've done. Is it?
Yes, sir.
Yes. So now those wages become direct because you can know that on these units of output, each unit is paid this much, so the total payable is this. Then when we talk about direct expenses, those should be those that are directly related to the production of a good. For example, if you take the example of royalties, I'll give you the example of Coca-Cola International, which is the mother for century bottling in Uganda, the manufacturers of Coca-Cola products in Uganda. Coca-Cola Uganda, under the flagship of Century Bottling, does not own exclusive rights to operate and produce Coca-Cola products because it is a franchise of Coca-Cola International. But it gets clearance by subscribing annual fees to Coca-Cola International, the inventor of the Coco brand, so that Coca-Cola International allows Century Bottling Uganda operating under the Ugandan franchise to produce Coke products. And by doing so, it subscribes for what we call the formula. That formula is only kept by the inventor of the product. So for you to be granted permission, you pay royalty fees. Royalty fees is like you are paying for an intangible asset, which earns this money. And you realize that without being given the formula, you cannot produce Coke. So what happens is they allow you by subscribing royalties. Then the amount you've paid, maybe for a particular year, you simply divide by the number of bottles or crates you produce a year, so that you know the cost you can attach to every crate in relation to royalties, which are direct expenses. Does that explanation seem to be understandable and making sense to you?
No, sir.
I am saying direct expenses must be directly traceable to a unit of output. So when we talk about royalties, or if that is a bit strange, if you invent something, you own its patent rights, not so? Now, for any party to use that invention, they must pay you. They must pay you. Now, in this case, if we are talking about manufacturing, for a Coca-Cola to be produced in Uganda as you see it, the Ugandan investors do not have the rights unless they subscribe for them. And by subscribing for these rights, they pay what we call royalty fees. Royalty fees. You are paying these royalty fees as expenses to pay respect to kind of acknowledge the efforts of the inventor of the formula for this product. Because you need to produce a cocoa in Uganda, which should not be different from a cocoa in Kenya, in Congo, in TZ, in the US, in the UK, you must be using one formula. And this one formula was invented by the mother body, which is Coca-Cola International. Now, for you, you keep subscribing every year to be allowed to use the name Coca-Cola on your products, but also to be given the rightful formula for producing Coca-Cola. The formula I'm talking about, how do you mix these ingredients to produce that beverages? It is the same taste across the world. Now, the fees you pay is called royalties, and it becomes a direct expense because without you being granted permission and given the right formula, you cannot produce a cocoa to be a cocoa. I can give an example. Reham products have what we call a Reham Cola. Pepsi products have what we call a Pepsi Cola. But we also have Coca-Cola as a product. You realize that if you tested a Coke and a Pepsi and a Reham, much as they are all colas, but the taste is different. Is it so?
It's so.
Now, what makes it different is the formula that each uses. Much as they are all colas, but they are differently mixed. And the mixture for making a Coca-Cola is only exclusively owned by one particular individual who invented the Cocoa brand and the formula for how it should be. So you keep paying for you to be granted permission and given the right formula to produce that product. In so doing, you'll be incurring direct expenses related to the production of a cocoa in Uganda. So if you paid maybe 20 million a year and you want to know the amount attributable to each unit, then it's going to be total output, then divided by how much you paid. If you paid 20 million, then how much have you produced it? And so you can know how much relates to each particular unit of output. Does that make sense?
Yes, sir.
Okay. Now, when that is done, a combination of direct labor, direct material, and direct expenses gives us what we call prime costs. Gives us what we call prime costs. Now, on prime costs, we add what we call indirect manufacturing costs, or call them manufacturing overheads. These include indirect materials. In other words, those materials may hardly trace on a particular unit of output. Take the example of manufacturing furniture. Maybe you have a carpentry workshop and you manufacture tables. Do you realize that you may need to use a marker pen to make those lines? Maybe how to when you are fitting in the various pieces of wood to make a table, or joining this and the other, you have a ruler and you have a writer, maybe a mark or a pencil or so, but you can hardly tell how many pieces of wood can a particular mark or pencil apply on. So whereas you have bought it as material, it becomes indirect because it cannot be directly traceable to a particular unit of output. We can talk about indirect labor. We said that direct factory wages relate to paying output per unit. I mean, paying per unit output. But then you realize that there are those people who work maybe on the factory, but not necessarily in the production area. For example, an askari, you are paying them to guard the factory, but the factory excludes is not only made up of the production unit. It has maybe a manager's office, it has a compound, it has a parking yard, and all of those relate to the factory, but not a particular unit of bread produced. So that one becomes indirect labor. Factory rates. This one can relate to when maybe you are renting where you operate from, and maybe you pay premiums. I mean, you pay to the landlord. The piece maybe is on a leasehold or a freehold land tenure, so you need to be paying the landlord lease rates or rental premiums for occupying their land. But to understand this better, instead of factory rates, you can also use rent for the factory. Factory insurance is also an example, factory maintenance, and even depreciation of machinery. All of these and several others become indirect because you cannot directly link them to a particular unit of output. And if that is the case, a combination of prime cost and manufacturing cost give us what we call the total production cost. And it is that total production cost that we now take to the trading account to replace purchases. If we do not do any purchases, but we only manufacture and sell. Does that make a sense? Hello, hello, hello. So now these other expenses are taken to be run as the usual expenses, administrative, selling and distribution, then financing. All of those get to be taken to the computations of profits. Then we can have classification of costs. Now we are just extending this. We have said that all manufacturing costs which are directly and readily identified with a particular unit of output So we are saying that all manufacturing costs which are directly and readily identified with the finished product and significantly become part of it are called prime costs, which are direct materials, direct labor. This is what we have been saying before. Okay. So then the manufacturing costs will consist of prime costs plus all indirect manufacturing overheads. Something needs to be improved here. Let us go back briefly here in this slide. Instead of calling these manufacturing costs, they are supposed to be called manufacturing overheads. There is a contradiction here. Something like that. So a combination of prime costs and manufacturing overheads give the total production costs. Are we there? So when we are to get the total production cost or the total manufacturing cost, we shall add prime to manufacturing overheads. Manufacturing overheads are supposed to be indirect costs. So when we come here, we are saying that the total manufacturing costs will be made up of prime costs and indirect manufacturing overheads. Manufacturing costs are calculated in the manufacturing account, which is later closed, and the amount is transferred to a trading account to calculate the gross profit. Other costs such as administrative, selling and distribution costs and financing charges are shown in the profit and loss account as operating expenses. So now, can we break it down those costs one by one, the ones we've been talking about? Direct materials, one of them, direct materials cost, we are saying is the cost of raw materials and supplies that are used directly in manufacturing a product and then significantly become part of it. So I've given examples. If we are talking about bread, wheat is an example of direct material. wheat flour. I think even sugar gets to be part of the direct materials. Do we use water or milk? But at least we can know which quantity is put in which quantity of water or milk is put in which quantity of wheat. All of those can be known to be direct. Okay. Direct labor, we are talking about wages of factory workers. And their tasks that are directly connected with the production process, and so shall take this as a direct cost. Direct expenses, we talk about any other direct costs that is neither direct material or direct labor is categorized. I tried to explain royalties here. I think it made some sense. The indirect manufacturing costs or overheads are also known as factory overhead costs, and they are manufacturing costs which do not directly vary with the quantity of output. These costs cannot be classified as prime costs. Okay, and so they are factory overhead costs. They are also fixed costs. So I've given all of those that do not get directly traceable to a particular unit of output. They become indirect overheads. Then administrative expenses, salaries, for personnel, depreciation. Apart from depreciation that relates to production machinery, the other depreciation will be put in the income statement section of expenses. And so on, as we are going to look at practical examples. Selling and distribution expenses, even financial charges, all of these, I think we can now know that they are part and parcel of the income statement, not the manufacturing account. Salaries for sales representatives, selling commissions carried out towards depreciation for delivery vans, and then promotion and advertisement expenses, discounts allowed, all of these selling and distribution expenses. Financial charges will include expenses directly involved with the cash movement, such as cash banker charges, such as interest on loans, etc., etc. Okay, this is how a manufacturing account looks like. Please briefly look at it, then I explain. Have we made the sense of how a manufacturing account looks like? In other words,
yes, sir.
It begins by recognizing the direct costs, which are raw materials, direct in nature, direct labor, and direct expenses. Okay, so we look at the opening value of raw materials And then we add whatever we've purchased as raw materials during the year, minus the closing stock of raw materials. We get to know the cost of materials consumed in that manufacturing process. Then we look at direct labor and then direct expenses, and the combination of the three, that is direct materials, direct labor, and direct expenses, gives us what we call the prime cost here. Then we come and trade indirect manufacturing costs, such as rent for maybe the factory that we operate at, indirect wages, general expenses, and any other that can be in that line. Then when we total them, we get what we call the total indirect manufacturing costs. And so a combination of prime cost and indirect manufacturing costs gives us what we call the total production cost. This is what I'm talking about. Let me somehow explain it using Excel so that we can maybe make some sense of it better. We are saying that we are going to talk about direct costs, and this will be direct materials added to direct labor. Sorry. Let me do it this way. So we are going to have direct materials plus direct labor and direct expenses. Now, all of these three will be giving us a figure these three combined are supposed to give us a figure that we are going to be calling it's supposed to give us a figure we call just a minute.
In prime cost.
So this one should be, I'm trying to make an entry here. And I wanted to change its color for helping you flow very well. This figure can be, is blue, okay? You can see. Now where you see that figure, we are calling it prime what? That prime cost is a combination of direct material, direct labor, and direct expenses, and all of those give what we call direct costs. So totaling them gives us prime cost. Then we add manufacturing overheads. Manufacturing overheads. OH is for overheads. You can understand it like that. Now, as we add manufacturing overheads, all of those that are indirect, you can have indirect material, indirect labor, and indirect expenses. I've tried to give examples. I don't know whether we've picked them. So like that, I can also change this color. And then we total them. So what comes out there is going to be called total manufacturing what? total manufacturing overheads. We can have the figure here. Let me change this for now. A combination of total manufacturing overheads and prime cost is supposed to be giving us total total production cost for the year. And that figure gets to be this one. Now that figure is what we transfer to the trading part of the account. So it is this one. I hope people are trying to follow. This one is what we transfer Does that make sense? Yes, Chiras, does that make any sense to us?
Yes,
Yes,
sir.
sir.
Yes, sir.
Yes, no, I think yes.
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 Now, if this is understood, what is important is to know what are direct materials, what are direct labor, what are direct expenses. What about indirect materials, indirect labor, and indirect expenses? Then we can be in position to tackle a question that comes in that perspective. So we can now go back and look at our notes again and see. You realize that we can now have, are you seeing this as an example? Try to read. Try to read. Okay, ABC Enterprises deals in production costs, details of production costs for the year ended 31st December 2017. 1st January inventory of raw materials is that. 31st December inventory of raw materials is 7,000. Raw materials purchased 8, and in manufacturing direct wages is 210. Royalties of 15. Whereas indirect wages are 90,000. Rent for the factory, excluding administration and selling and the distribution blocks, is 4,400, whereas depreciation of plant and machinery is 4,000, and general expenses are 3,000. Can you prepare a manufacturing account for the year ending 31st December 2017? Okay, I take you back there. Read again for 1 minute. Then we agree on what ought to be done. Have you understood with the question?
No, sir.
Hello, hello, hello.
Yes, sir.
Are you understanding the question?
Yes. You first. Okay. Can you put the next page, please?
I hope we are there. So can we now prepare a manufacturing account for the year?
Sometimes, sir.
Sorry? We do what?
Wait, question.
I'm not hearing.
Wait, question.
You don't need to be copying this question. The question is already attached to you in your notes. Moodle has it.
Let's proceed, sir.
Okay. So all we want is to have a manufacturing account prepared. Just understand which information goes where. That is what is important. It is all about understanding which information gets posted where. And when you read the notes, I believe information has been put in here and well recorded. If you read the notes, you will see that everything is okay. Okay. So can we have this solved? So what we want is to prepare our account manufacturing in nature. The business is called ABC Enterprises. Is it limited? Manufacturing. Okay. I think it is something like that. So what we need is to be in position determining the cost that would be taken to the income, the trading account. And we said that we shall start with direct costs, from which one is supposed to be direct materials. And under direct materials, we have to adjust as below. We have opening stock of raw materials, not so. We have an opening stock of raw materials of how much? Those who manage it down is 5,000. Please, you can mute. What about purchases of raw materials?
$80,000.
Sorry?
80,000.
80,000. What does that give us? It gives us a particular total, not so?
85,000.
85,000.
Then we have closing stock of raw materials. How much?
7,000.
7,000. And this one should be put in brackets. Okay, let me put it there forcefully using a pencil. 70,000. So what do we get?
77.
Yeah, 78.
So that's what we shall get as the direct material. So we are supposed to put it here. Let me first get it out from there, because once we total, it does not enter there. Once we total like this, then it is meant to come. It is meant to come here. It is going to be 70. Are we okay? Then direct labor.
Sir, the speed is too much.
What?
The speed is too much. Yes.
What have I done wrong now? When you add 5 and 8, you get 85. When you subtract 70, you get 78. Okay, where is the problem? Yes? Class, is that speed too high?
Yes, sir. Sir, so our problem is, are we having 2 parts of shillings? Because when we're doing when we're copying the table, it's 1 part of shillings, but when you put in the 78,000, you're having like 2 parts of shillings. So I'm lost from there.
When you are copying the table, you have?
Sorry, it's my mistake.
Thank you for acknowledging your mistake. So direct labor is how much? Direct labor? Look at the question. Manufacturing wages direct. Those have been put for years 210. I can see it as 210 because those are the ones that relate to production. I think let me add just this. This is 78. Let us put it like this to save space. That is how it is. What else do we have directing in nature? According to the question, members, we have royalties, and we say these ones are direct what?
Expenses.
Royalties. We can put them here as you can quote them as royalties. And these ones we saw are direct. So you can bring them here and talk about 1.5, something like that. Anything direct that we have not tackled? So prime cost. Prime cost is how much? Yes. Is that what you get?
Yes.
So that means having determined the prime, we are not supposed to add. We are supposed to just leave it there and then we attach the indirect manufacturing costs. So now we add indirect, because those are the ones that are directly related to the product. Now we add indirect manufacturing overheads, and we start one by one. The first one, according to the question, is what? The first one is what? We only have indirect labor, that is indirect wages, plus
Rent.
factory rent, plus depreciation on plant, because all of these relate to production. And then the general indirect expenses. So we have indirect labor, indirect wages plus rent. What else apart from rent? Is it depreciation? What else? Our space is finished. But okay, can you enter those? Can you enter wages, indirect in nature? You also enter rent and you also enter this depreciation. Then what else do we add? We add the general expenses. Rent is 4,4, depreciation is 4, general indirect expenses are 3,100. $3,100. So you add them all. Have you added?
No, sir.
Indirect labor is 90. So you're going to come here and put 90. After which you add rent is 4,4. Then the other one is 4,000. What is that? Depreciation. The last one is supposed to be 310, 3,100. $3,100. When you total those, where do you stand? Where do you stand? What figure do you get when you total these together? I can see one of my figures is eaten up. I've tried to extend the board. Where are we when we total up?
100,
100. You are saying it
1,000.
100. 100, 1,000.
500.
Members are up. 100, 1,000.
500.
So now to get the total manufacturing costs, you are going to get prime costs plus indirect what? Manufacturing overheads. So prime cost is 289. Then indirect manufacturing overheads. Indirect manufacturing costs, this one is equal to 100, 1,500. What is the total production cost? Class, can we add?
391,000.
300.
91,000. Rent is 4,000. It's 4,000.
Something like that. Anyone with that answer?
Yes, sir.
Yes, sir.
Okay, so this one now forms what we call our total production cost. That we are going to take it to the statement of to the trading account to replace the value of purchases if we are preparing for manufacturing organizations. If there is any question, please, it is welcome before we can proceed. Any question? So it is this component that you are taking to the manufacturing account, I mean to the trading account, so you can compute your cost of goods sold. Okay. I think we can continue to look for another example. So there we are. Have we understood what I've been explaining? Yes, we have understood. So can we now understand work in progress? Members, don't go silent.
Sir, let's go on.
Sorry?
So we are present.
You are not good people. Of course, we shall do another example. And let us do it as we go on. Let us look at work progress, then we will continue. So as you read it through, let me pick a glass of water. We are going to have an example, but we are going to combine it with what I'm going to again look at, so that we are in position to compute the costs very well. Now, we have a concept we call work in progress. And this term is the cost of goods whose production remains incomplete during the production process. The cost of production transferred to the trading account is the cost in respect of goods completed. Therefore, work in progress is anytime it is involved, the total cost of completed goods is calculated by taking care of this work in progress. That is, we deduct it. You might start a process and before the year ends, before the process is complete, the year ends or the accounting period ends. Because of going concern and because of the going concern concept, we do not look at that process as a botched one. We continue with it because we know what we didn't finish last year can be finished in the current year. In so doing, we take adjustments as we are going to see, because you might have, as you start the year, you start with what was not completed last year. That is opening work in progress. But then as you also end the year, you end with what remains incomplete this very year. That is the closing work in progress. So in either cases, we want to see the treatment and how we also get the production cost, even when we have work in progress. So where work in progress exists, we do the following. We get the total production cost for the year plus opening work in progress. Whatever we get, we subtract closing work in progress. And then we get the production cost of goods completed in the year. So you first come through up reaching the point of determining the total production cost. Then you look at whether you had work in progress or not. And if you add it, you make the adjustments as one. You add the opening work in progress to the total value of finished products, or the total production cost for finished products in that year. Then you subtract the closing work in progress. And once that one happens, we shall have accounted for it. For instance, if we have the following information, we can calculate we can calculate the transfer to the trading account. Production costs last year on goods which were not completed but completed this year, that is work in progress, equal to 3,000, but that should be opening work in progress. Then the closing work in progress, that is production cost this year on goods which were not completed, equate or equals to 4,000. So if you are asked to calculate, the production cost for the year, you must ensure that now when you have work in progress, you interrelate and incorporate it, so that you can now get the actual figure for the goods produced during the year. Okay, we can have an example. You can read it through. And we'll do this detailed one. I think it should be in position to help us get there. That is what we start with. Are we there? Should I go to the next slide?
Yeah, wait, sir.
We continue.
Yes, sir.
Yes, yes, sir.
That's the next page. We go. Members,
Yes, sir.
I hope we've read and understood. Okay. We have the first part, which is here. That is the first part. And then it is accompanied with the second part. You are asked to prepare. Okay, inventory of raw materials on the beginning of the year and the closing inventory of raw materials have been given, work in progress opening and work in progress opening. Then direct materials are there. Direct raw, sorry, packets of raw materials is also there. What else? We have lubricants, we have lubricants, we have carriage inwards on material, we have rent for the factory, depreciation on factory and plant, machinery, internal transport expenses, and insurance. and then general expenses. So prepare a manufacturing account for the year. Prepare a manufacturing account for the year. Can we do that? Can we do that? By going back and identifying, as we said, starting with the direct material, direct costs, that is direct material, that is direct labor, and direct expense. Let us start. Let us start. I want us to pay keen attention so that we don't get lost. I think I should use Excel in this case. Let me open Excel. So they've told us to prepare.
Yes, sir.
Sorry? Hello? Someone is complaining and I cannot hear what they are complaining about. So, okay, we start with direct materials. This business has no name. The business has no name. Hope what I've put there is a bit visible. So we start with direct materials. Direct materials. Someone is complaining about the size. Okay, let us make it big. Hope that is big enough for people to see. So direct materials, we have opening stock of materials. How much is this?
8,000.
Then purchases for materials.
87.
Sorry?
87,000.
87. Then the other one is on anything else here?
closing stock.
You need to first add this so that you have then closing stock is how much?
10,500.
10,500.
10,500. So all of this can be made magnified. I think let the currency item come here. So to get the direct materials used, we are going to get this. Should be this. And so I think we are around there. That is the total direct materials used, not so? This one can be simplified like this. So that's where we are. Now we can go ahead and determine labor, not so? Direct labor, back to the question. We have direct labor of how much? We have direct labor of 39,600. Let this one come here. 39,600. Direct expenses. How much according to the question?
1,400.
1,400. What else do we have here? I think these are our prime what? These are our prime costs. These are our prime costs, which we can total up here and we call them prime. Are we together? Are we together? We can see those are our prime costs. Now, once we have the prime costs, we now add on what we call the indirect manufacturing overheads. Indirect manufacturing overheads. I think there we are. So what are they? We go to our question and identify them. Indirect manufacturing overheads. Do we have indirect material? Indirect material. Yes, no. Class? Class?
Yes.
Hmm? But on
Returns
purchases
and
of
depreciation.
materials, as if there is something we didn't capture. There is an item to do with the carriage. Did we take it? 2,000. Supposed to increase the cost of material. I think we would have added somewhere here. Are we together? On materials here, we are meant to add something to do with carriage. Are you seeing that 2,000? Hope we are together. I've increased, I've inserted a 2,000, which is the carriage inwards on material. That should just be increasing the cost of materials. So once we have it, and then, so what we now do is to determine the overheads or indirect costs we have. I don't think we have materials, but I know we have wages, indirect, we have rent, we have insurance, we even have the general factory expenses and the depreciation. Not so? Can we now trade those? Can we trade those? Indirect wages, you can see we have, it is 25,500. What else do we have as indirect according to the question? Indirect. Are you seeing rent for the factory? Members, are you still there? How much is rent for the factory?
7,000.
We put 7,000. What else is there to be traded? Depreciation of plant, factory plant and machinery is also an indirect manufacturing overhead. How much? Members, how much?
4,200.
4,200. What else? Insurance of factory buildings. Please, those are the ones we said that all that relates to the factory and is not direct, it becomes indirect. Members, try to remember that. How much?
1,500.
The last one? The last one?
General factory expenses.
General factory expenses. How much?
It's 3,300.
How much does this give? How much is this? We have 41. So this is the total indirect, or called total manufacturing overheads. And how much is the figure? We've gotten it here. These ones can be made more. So this is the figure which we can also summarize. Then we get, when we do that, we get then, which name do we give to that? Which
Total
name?
production cost of the year.
Sorry?
Total production cost of the year.
That one cannot be for the year since we have worker in progress. We still have to
Excuse
adjust
me,
the
sir.
worker in progress.
Excuse me.
Yes.
Yeah, what if we just, after getting the work in progress, we just add total production year for the goods completed? I think we
Exactly.
just added.
Exactly. Total production cost. You can even simply call it total cost of okay. So this is during the year. Now that during the year is going to be a combination of this and this. Sorry. It should be these two, that is this plus this one. Can assume another color. Then down here, it becomes what is completed for the year. This one can also assume another color. I think it remains vivid when I change the color to that. Now, we add the opening
Excuse me,
work
sir.
in progress.
Excuse me, sir.
Yes.
So I'm lost on that name.
Which one?
The total cost of goods completed during the year. I thought it should have been the total cost of goods during the year. Then on the other one, you had completed.
Sorry?
I thought it should have been the total production cost of the goods during the year. Then after calculating the other ones, then you add the word completed later.
Okay. We can take what makes you comfortable, but the name would not really matter. So we add opening work. That is the opening work. work in progress of how much? How much is the opening work in progress? Members, how much is the opening work in progress?
3,500.
3,500. When we add, what do we get? When we add, that's the figure we shall get. So it is on that figure that we subtract the closing work. So let's what will that figure be, or what is it?
4,200.
So what is the resulting figure? Since we are subtracting, let us take this one as the what is the resulting figure? And the name, I think, will now be the total production cost of goods and it is this figure that we also transfer to the trading account. Okay. It is this figure that goes to the trading account for the year to replace what would have been the figure for purchases. Does it make sense to us?
Yes.
Someone says I made a mistake somewhere. Where?
Excuse me, sir.
Hmm.
Yeah, I think there's a mistake somewhere. Because, like, okay, the direct materials, when here, let me say the closing stock, when you subtract 95 from, I mean, 10,500 from 95, you get 84,500. But for you, you're having 86,500. So here, the
Because
prime cost.
Because we said that
Mm.
on material purchases, there is a figure we had left unattended to. And that
Okay.
figure is this one, the carriage,
Oh, I now get.
which we had to reinsert.
Okay, thank you, sir.
Welcome. Is it now okay?
Yes, sir.
So that is what would be our, so now this one, this figure here is what becomes the figure we take to the income, I mean the trading account, to now replace. It replaces what would be purchases. Okay. That figure replaces the purchases figure in the trading account. It is this one here. That is 168,300. Is there any confusion on how to generate the manufacturing account?
No, sir.
Maybe where I can slow. If I can throw more light here, let me take you back to the question. So this is what we have generated. I don't know whether I was sharing the screen, by the way. Was it shared during the workings or? Okay, if we are to throw more light, we can come here and try to make some other meaning. Now, these other figures you see like a fuel and power, since they are not anywhere quoted as relating to the factory, please, you do not bring them in. You take them to administrative, to the other section of expenses, that is administrative expenses, selling and distribution. Then lubricants, they are not telling us that they relate to the factory, so you let go them to the other section. Internal transport expenses, don't bring in, okay? Then, yeah, those expenses that do not directly link to manufacturing activities, we don't force ourselves accepting them to be this side. We must take them where they belong. You get? Hello?
Yes, sir.
That is what we do. That is
Excuse
what
me, sir.
we do. Sorry?
Excuse me, sir.
Yeah, excused.
Yeah, are there also circumstances where they can give you correct outwards, and maybe if they've given you, where do you put it?
If it is carried outwards, it is a selling and distribution cost. So you take it under administrative expenses. Okay. Any other question? Any other question?
I think there's no question, sir. Maybe we can continue.
Okay, if we are to continue, we are going to go to appropriation of expenses. Apportionment of expenses. That is, we want to allocate these expenses to the various expense heads, the various cost centers, the various cost units, so that we clearly get to know, that is, if expenses are shared amongst units, can we know which component is for which unit and which component is for which other unit? You get? And so we introduce this one. You can read it through briefly, then I start the explanation. Have you read it through?
Yes, sir.
Okay, so we are saying that so we are saying that quite often expenses will always have to be split between the indirect costs to be charged to the manufacturing account, those that relate to the administrative expenses, those that relate to the selling and distribution expenses, and even those that are for financial costs or financial charges. It is important to note that administrative expenses, selling and distribution expenses, as well as the financing charges are always charged to the income statement. It is only the indirect manufacturing costs that are charged to the manufacturing account. An example of this could be rent as an expense. If the rent is paid separately for each part of the organization, it becomes easy for us to know which rent to charge to which section. But if it is combined, it becomes hard. So we need to know which goes where by doing an apportionment. And how do we do apportionment? We are going to look at the bases, the various bases that we can use. If only one figure of rent may be paid without an indication as to how much is for the administration building, how the rent expense will be appropriated or apportioned is, in the latter case, depends on the circumstances, and it is done using the most equitable way. So we can look at the base. Is it floor area covered by the office space versus the factory space? So we can use that ratio. We can look at the value of the assets, maybe to charge depreciation. We can look at even apportionment ratios like we are going to see, so that we have the basis for attaching expenses where they belong. And all this will be well guided. We shall get ratios, we shall get percentages, we shall get maybe other measurements, can be floor area, it can be any, but it will be so clear for us to know which expense relates to which unit and in which quantities. To apportion is to allocate expenses to their respective units depending on known bases. So we can have an example. You can read inventory of raw materials on first is that, and inventory of finished goods is that, and the work in progress is that is opening. However, wages, those that are direct are 80, 180, and indirect for factory 145. Royalties are 7. Carried inwards on materials is 35. Purchases is 370. Productive machinery cost is which costs 280 is at the date of reporting valued at 230. The administrative computers that bought 20,000 are now valued at 120. General factory expenses are 31. Lightening is 75. Factory power is 13,700. Administrative salaries are 440, as rather 44. Sales representative salaries are 30. Commission on sales is 11,500. Rent is 12. Insurance is 42. General administrative expenses is 13,500. Banker charges is 23. Discounts allowed 4.8. Then we have carriage outwards as 5,900. Sales is 1 million. Accounts receivable and payable is 142,364 respectively. Banker balance is 16,800. Cash is 15. Drawings represent 60,000. The opening capital balance is 357,800. And so the trial balance is balancing at 1.421,800. This information is discovered that the inventory of raw materials and finished goods and work in progress were those. Now those ones should be the reporting inventories at the end of the year, because we are saying that additional information at the end of the year is as follows. Inventory is in materials is 24, inventory in finished goods is 40, and work in progress is 15. Lighting, rent, and insurance are to be apportioned at 5/6 factory or 1/6 administration. That is apportioning. Depreciation on productive machinery is going to be, productive machinery and administrative computers is at 10% per annum on cost. Can we prepare financial statements of the above information? In other words, can we prepare the income statement and the balance sheet for this business? Well, knowing that you prepare a balance sheet, an income statement, we start with a trading account, which must contain cost of manufactured goods. And so we cannot come to the trading account unless we know the manufacturing account. So can we do this example, which is a bit comprehensive to guide us? Okay, you can have a chance and read over it again. It is still available for us to read. Okay, you can read over it again. I'm still displaying it. It starts from there. You can read. When you finish, you tell me we proceed one by one. Have you read the first part of the question? Or if you downloaded, you can even follow from your systems.
Next.
Okay. So the second part is there. continue the second last part. And I think now the last part. I hope we've understood the question. I just hope we've understood it. Okay. Now, solving this question comes in. You realize that what we need out of this question is the following. We have been asked to prepare the following. One, okay, we have been asked to prepare financial statements for the business for the year. I think this year is 2017. So what does this mean? If we are preparing these financial statements, it means that if this is what is required, then it means that we are going to prepare the following. Statement of comprehensive income, statement of financial position. Now, if that is the case, it means that to prepare the statement of comprehensive income, one needs to have to prepare the statement of comprehensive income. We are going to need here we are going to need the following. We are going to need a trading account, and then we are going to need a trading account. The other one should be a profit and L. Profit and loss account. Now it will also mean that for trading account, I'm trying to break it down so that you understand it. It will mean that for a trading account, this one, you cannot do it unless you have prepared what we call the manufacturing account. That is where we must start from. And in a manufacturing account, it means we are going to begin by ascertaining. We need to first have begin by ascertaining, or call it determining, the production cost of finished goods. I hope that breakdown helps to focus this question. Is it okay? Basically, that's what we need to go through if we are to get we can't stop the class here, you woman. Please, Madam Nalubanja. You want us to end the class here? Hey, God is seeing you, Munang. Who is buying into her idea? Yes, no.
At least a break, maybe, Master.
Eh? Okay, we can
Give
allow you
us a
break.
break.
Okay, you break for 10 minutes.
It's okay.
Okay. I think we have rested a bit. Yes, sir. So we can prepare to go back to class and look at some of these things and how we want to do it.
Yes, sir.
The person asking for a break, are you now okay? Let me first see
Yes,
her
sir.
name. She was by names of Nachirija. Nalubanja.
So we are.
Oh.
I'm fine.
No, it is okay to express your feelings.
We are ready.
We already decided. It's okay. You can continue.
So, okay, before you went for break, we said that ahead of us were tasks that required us to prepare financial statements. And at this level, financial statements mean the statement of comprehensive income, which is also the income statement, and also the statement of financial position that you popularly refer to as the balance sheet. The statement of comprehensive income is supposed to embed a trading account and the profit or loss account. Those two make up the statement of comprehensive income. Now, in the statement of, the trading account is where we prepare a manufacturing, which is where we need to include the components of the manufacturing account, because when we do the manufacturing account, we shall be in position to ascertain the production cost of goods produced during the year. So we do that, and then we are good to go. I'm going to go back to the Excel sheet. I think I can open a new page, and we answer that question from there, from the Excel. Now, the question that I've read and you've read is asking us to do the following: to do statements. Okay, it's asking us to do financial statements, and we have said we are doing the income and then balance sheet. To do the income statement, we shall need to have a trading account, and to have the trading account, we must begin with the manufacturing account. So we go to we come here and do a manufacturing account. What's the name of this business? Does it have a name? It does not have. So it is the manufacturing account. Hope we are there. That is our title, and that is, I hope, seen. So we start with the opening stock of raw materials. Opening stock of raw materials. Let us quote the currency here. I think we shall also need it here. In either cases, so opening stock of raw materials. How much is it?
21,000.
81, 21.
21.
Okay. Then do we have purchases? So we add
370,000.
Purchases. I hope my letters can be seen. Purchases of raw materials. So you said this figure is how much?
370,000.
370,000. What else do we have? We have carriage on raw materials. How much is that?
3,500.
3,500. When we do that, where are we? That would be our total. Not so? That would be our total, and so we can now take off closing inventory of raw materials. How much is that? Yes, how much? Class, how much is our value for closing stock of raw materials? The last part of the question is asking you to take into account the additional information at the end of the year, and the closing stock of raw materials is 24,000. 24,000. So this one we can so that's where we shall be. And so how much is our direct materials? These are the direct materials consumed. Direct materials consumed. And the figure is here. The figure is here. For us to see.
Excuse, sir.
Yes.
I've
You are-
not understood how you got 24,000.
Sorry? I've not
I've not
heard.
understood how you got the 24,000.
You look at the question,
closing
the 24,000 is
stock
there. Don't you have the question?
materials. I've not understood how you got the closing stock of raw materials, the 24,000. Okay.
Have you seen it? Have you seen it? Okay. So that means we are speaking the same language now.
Thank you. Yes, sir. Thank you.
So we now have the cost of materials consumed. Can we talk about direct labor? Direct labor?
$180,000.
Hello.
That information should be in the trial balance. It is not coming by magic, okay?
Excuse me,
So-
sir.
Yes.
I struggling to observe where you have got the closing stock, which is 24,000. For me, I haven't seen it in the
You open the
question.
question.
I think I'm in the question right now.
You read the question because I ended by sharing where I got it. Maybe you are not paying attention.
Is it in the first part?
My
Maybe
friend.
second.
Read the question, because if you don't understand the question, you will not pick anything.
Okay, let me try to.
So wages direct, those ones represent the component of direct labor. So you can call this direct factory wages. And it is 100 and what? Is it 180?
180,000.
Anything to do with the labor beyond that? As if I don't see. Okay, if there is nothing to do with the labor direct in nature, can we take the direct expenses? The only entry I see here, those are royalties. Not so? And royalties amounting to how much?
7,000.
Royalties amounting to 7,000. So if this is where we are, can we now talk about our component of the prime cost? This figure here is now the prime. It is the prime cost. Can change the color maybe to this. Hope we can see the prime cost. And that is how it has come to be. We've combined, you see, under direct labor, under direct wages, we have direct factory wages. Under direct expenses, we have royalties. Okay. So now a combination of material, labor, and the direct expenses gives us what we call the prime cost. Now, can we go to the indirect manufacturing overheads? Indirect manufacturing overheads. So we look at them one by one. We go back at our question and try to track them. I don't know whether we have indirect materials, but at least I can see we have indirect wages. I can see indirect wages if you read your question. Indirect wages to a tune of 145. I hope you have seen that in the question. The indirect wages are there. Then we also have
Excuse me, sir.
You are excused.
I think wages is direct.
Sorry?
But wages is direct, not indirect. But then we have factory, which is indirect.
It is wages split into direct and indirect. Okay. Are you seeing factory indirect wages?
Yeah.
Yes. Productive machinery at a cost of 280 and the current value is 230. If I'm not mistaken, they asked you to depreciate because we are looking for indirect manufacturing expenses. They asked you to depreciate machinery and computers at 10%. So it means you're going to come to productive machinery at cost, you apply 10%. 10% of the 280,000. 200,000, 280,000. This is what I'm trying to mean. This is the value of productive machinery at cost, not so 280. But they are asking you to depreciate productive machinery. Depreciation on productive machinery should be at 10% per annum on cost. So we get 10% of the 280 because the cost was 280. So this 280 is subjected to 10% for us to compute depreciation, which will now make it how much?
28,000.
So depreciation on productive machinery. Machinery is 28,000. 10% of the cost. What else is an indirect manufacturing cost? What else, according to the information we have here? Computers, please don't charge depreciation on them. And even when you charge, don't bring it to do not bring it to the manufacturing account because it does not, they do not belong there. But general factory expenses can be brought in. General factory expenses can be brought in because they are not, just a minute, since they relate to the factory. We are saying general factory expenses can be brought in, okay? How much? That's what I can see that relates to factory expenses direct in the general in nature. What else? We are still looking at expenses. To the question. That part is done. We continue. Lighting, was there any note on lighting? We come here. They are saying that lighting, rent, and insurance to be apportioned as factory will take 5/6. So you come to lighting, which is 75, you subject it to 5/6 so that you get what belongs to the factory. So lighting, are you still following? So this lighting should be 5/6. We are going to charge it as 5/6. 5/6, and whatever comes out, we multiply it by 75, not so? So what is the figure? That's the answer. 5/6 by, please help me. Five over 6 by 75.
6,250.
Sorry? 6,200 and
6,250.
There we are. The same treatment is going to be given to
6,250.
that one we have done. The other expense that is, I think, factory power. No. Insurance and rent. Rent also do the same. Rent. We've been asked to take a 5/6. And whatever comes out, you multiply by the cost on rent, which is 12,000. So what will this be?
Rent will be 10,000 and insurance will be 3,500.
Rent will be 10,000.
Yes.
Then insurance
3,500.
Let me write. Insurance is again 5/6 times the cost for insurance was how much? Yes.
4,000.
Sorry?
4,200.
4,200.
Yes.
Okay. So what do you get as the resulting 300 and? $3,500. Members, I hope we are following. What else? You go back at our expenses. they have told us factory power, that one should be taken as it is. Sorry? I'm saying that factory power should be taken as it is because it relates to the factory, and this is 13,700. Then what else is there to take? General administrative, no. Discounts allowed, no. Sales representatives, no. Commission on sales, no. We continue. Receivables carried outwards, no. What else can we take here? I think that is that. I think that is that. We have captured the expenses that are for indirect manufacturing. I don't know whether we've left anything untackled. Now, if that is done, we are supposed to now come up with, okay. Let me first make this one appear like this. Then when we total this, we are supposed to have a total of 237,450. This is 237,450. That is the total you get when you sum all of these ones. I hope you have added also. So now these ones become total indirect manufacturing overheads. If we achieve that, we can even highlight this by any color of our choice. We shall not be penalized by highlighting since we are in class trying to understand. So it will therefore mean that the total cost, total product cost, that is now the current, actually this should be the best name, total product cost. Is going to be an addition of the prime plus the indirect overheads, so that the total product cost is this. You can even give this one another color. I prefer giving it that one. And so we go. Now, for us to go to the trading account, we need to add opening work in progress. Opening work in progress. And how much is that? The opening work in progress is how much? Hello?
13,500.
Sorry?
13,500.
13,500. When we do that, where are we? We shall be at that figure. And then if we take off closing work in progress, what is our closing work in progress?
15,000.
15,000. Please go to the last bit of the question. We will see it. It is 15. It is 15,000. Closing work in progress is 15,000. So this one can be written as an accounting number to be this and this, and then to be that. So that means that the production cost transferable to the trading account is how much? Production cost. This one is, we carry down to CD to the trading account. I hope that one makes sense, because this figure must report to the trading account to replace what would be purchases. Can even give it a color like I've done, and no one will penalize you for that. Okay, I'm doing this because we are doing online. Of course, physically, it is impossible. So that is the production cost that we transfer to the trading account. Have we understood preparation of a manufacturing account? I hope yes. Now that the manufacturing account is done, can we go to the income statement? So we come here. We are going to say, we don't know the name of the business, but we want to start from this point. Statement of comprehensive income. Comprehensive income for the year ended 31st December 2017. At least that much we know. And so we can produce it. Now, if that is the case, we just need to put our things right. I think we shall need this column, but we shall also need this column. Not so? So what starts in the income statement? We start with sales according to the info we have there. It is beginning with the sales. Which sales I pick from the trial balance? Somewhere I see the amount for sales. Amount for sales, let me show it to you. I think you can see the sales figure, 1 million. Not so? Okay, so we can go back to Excel because we have seen the sales figure. It is 1 million. What figure did we get for the production cost? Okay, I've seen it. So 1 million. Hope this is seeable. It is big enough for everyone to see. Now, after sales, we are supposed to have less cost of sales. Now, this sales of is opening stock. Now, this opening stock should be for finished goods. Okay? Of finished goods. I hope we are there. Finished goods. Let us not get lost. Opening stock of finished goods. Yes. How much is it? We have it in the question. Opening stock of finished goods. We have it somewhere.
38,900.
Sorry?
38,900.
Someone says 38,900, and that's a fact. 38,900. So can we take it to where it belongs? 38,900. We put it there. What else do we put? We add. Did we purchase goods? No, yes. Let me check. Here I don't see any purchases. I again don't see purchases. I again don't see any purchases anyway, yeah. But I think we have what? Finished goods. Yes, we don't have purchases. So what we put here is production cost of goods. cost of finished. Not so. So what figure did we carry? This one we can pick it from the previous statement, and it is here. Do we have, okay, here we add nothing because we don't have carriage on finished goods. Instead, we have carriage on. So we sum this. When we sum, this is going to be the cost of goods available for sale. I may not give it a name, at least you know what it stands in for. So it is the cost of goods available for sale. Then on that cost, you take off closing stock. This closing stock should be of finished goods. And how much is that? How much is that? Members, I'm counting on you.
40,000.
Sorry? It is how much?
40,000.
40,000. This one, I want us to take it as a number, this, that. So if we pick it here, it should be okay. And so, then we can even make it appear in a manner. So what is our cost of sales? Cost of sales will be that figure. And it is how much? Are we there? So it means that the figure cost of sales, the figure cost of sales traded with cost of sales traded with sales is supposed to give us the value of gross what? Gross profits. And so this is our gross. This is our gross profit. So you call it gross profit. And it is that figure. Can we now work out expenses? So less expenses. Now these expenses are quite many. You come back here and you will see what relates to what we're exactly doing. You have, let us go to where the exam starts, the question starts from. So carriage, what's that one we did? Materials we did. Okay, on the first template, we have to cater for depreciation on administrative computers. On the first part of the question, the first expense is depreciation on administrative computers. And the figure is how much? It is supposed to be 10% of the cost. The cost was 20,000. 10% will make it 2,000. If you are having your question with you, you should be in a position to see that condition. The other expense that we can take care of, I see we have administration salaries. If you go to the second slide of the question, we have administrative, administration salaries. And the figure is 44. Is it 40 or 44,000? The figure is 44,000. Which other expense? Those with the question, please. Which other expense
Yeah,
members?
So what
The
of the
sales
Sales
representative?
representatives. Sales representatives salaries. The figure is how much? Hello?
the figure is 30,000.
The figure is 30,000. Okay. Which other expense?
Also have bank charges.
Sorry?
Bank charges.
Bank charges. How much?
2,300.
1,000?
2,300.
2,300. What else?
They also have discount allowed.
Discount allowed. Yes. How much?
4,800.
4,000?
800.
What else?
We have lighting, rent, and insurance.
Sorry? We have insurance, we have sales, commission on sales. Commission on sales. Commission on sales. How does it get to be? How do you interpret that? Yes. Commission on sales. What I've done, I've not split between administrative, between selling. I will do that in the next example. At least now I want us to understand the preparation of the expenses. We needed to have operating, rather administrative. We needed to have sales and distribution, but I've not split. I will do that going forward, probably on Thursday next week. But just know that commission on sales is also an expense. You give it to the sales agents on top of salaries. You give them commission, not so? And how much is that? Is it 115? I think.
Yes, 11,500.
Yes, something like that. What else? Go to the question. General administration expenses there, but before we reach it, rent, we had to take 1/6 of the rent cost. 1/6, even lighting and the, so okay. So let us take a lighting to be, lighting was supposed to be taken as the, it's supposed to be, we are taking 1/6. That's the condition they gave us in apportionment. And the cost was 75. So what do we have? Is it 1,250? Is it?
Yes, sir.
Sorry?
Yes, it is the one.
What about on rent? Same condition was applying. Rent was also supposed to be 1/6 of the cost, which cost was 12,000. So what do we take for rent? If we took 10.1, it is 2,000. What about on insurance? I think it was insurance. Insurance. We were taking 1/6 of, I think 1/6 of, is it 42? To take it as which figure? 700.
700.
Hope we are still following. So now we can go back and look at these others. You have general administration expenses. Please bring them in as the total is 34. These ones do not relate to manufacturing. General administration expenses. The total is for 13. The total is 13,400. What else do we have? We have bank charges. We've taken care of them. So I think there we are done. We'll go to the next. The next carriage outwards, please bring it because it is part of the sales. It must affect sales. It is an expense. Carriage outwards. Even from the other, I think last semester I looked at it. Carriage outwards. Carriage outwards. Then you have, what else do you have? Among those expenses, I think they are done. I don't see any other expense. Maybe we'll go to those ones that we are given in the adjusting notes. Lighting catered for. Okay, I think expenses are done. Expenses are done. So we can sum up this to know our total expenditure is 117,850. 117,850. So once we have this as total expenses, total expenses, then we can know the net profit or loss. But I think it's a net profit in this case. It should be this minus this. And so you are reporting with a net profit of 89. Yes, this is your net profit for the period. Are we there? So it means that now we can go and prepare the statement of financial position. And I guess you are still on. We can prepare it. Yes, members? Hello, hello, hello. Let me make this.
Excuse me, sir.
Yes, you are excused, sir.
Good afternoon.
Good afternoon to you. How are you, sir?
I'm fine, thank you.
Uh-huh.
So, yeah, I'm just suggesting we should stop here, then we continue. We finish the rest of the question in the next lecture because I think the class is so exhausted at the moment.
But the class took a break, sir.
And it is approaching lunchtime. So I'm just suggesting.
But you are at home. Lunch can be eaten at any one time. When you miss it at one, you mean you will not find it. Wanji?
No.
Let us finish the remaining part so that you use, when I attach the recording, you can have where to start from. Then next week we consolidate. Because what is remaining now is very small, just coming up with a balance sheet. Just.
Let's finish it.
I like that energy. So now let us prepare statement of financial position.
Excuse me, sir, I have a question.
Yes,
Excuse me, sir.
you are excused. You are excused.
Sir, on that statement of comprehension income, I'm asking in case. Excuse me, I'm still talking.
Yes.
Hello.
Yes, we are hearing you.
I'm asking in case. Okay, in case we had purchases, what would have happened? Like,
if we had purchases of goods,
yeah.
yes, we would have come to this statement. We would have come here when we are computing the cost of sales, that section. We would have opening stock of finished goods plus purchases of finished goods plus production cost of finished goods.
Okay, sir, thank you.
Yes, like that. And even if we had the closing stock of finished goods, okay, that one we took care of it. So let us do the last one, statement of comprehensive income. Statement of financial position. So we have non-current assets, current assets. So you realize we have them at cost. We have accumulated depreciation. Accumulated depreciation. That is accumulated depreciation. Let me shorten it also. And then we have the net book values. We have them at NBV. So we have the first asset is I think we had productive machinery. Productive machinery. Yes, productive machinery. Maybe this cost is at shillings, even the accumulated depreciation is at shillings, even the net book value is at shillings. So we bought this productive machinery at 280. By the time of this business year, the value had gone to 230, and we also removed, so that means it had depreciated by 50,000, but we have also again charged 28 to make it, that is opening your value net book was 230, but then you have also removed 28. Where will you be? The difference should be what? The difference should be with, I think, 202. So this one becomes 78. That is the opening accumulated depreciation plus the current year depreciation to now give you this figure, the net book value. Let me hope we are still together. The next asset will be administrative computers. Administrative
Excuse
computers.
me, sir.
Yes.
The accumulated depreciation is 28,000.
No, that is current year depreciation. Look here. This is how we opened. We opened with this, that our productive machinery was bought at 280. Okay. But by the time we came to the current year, it had a carrying value of 230, meaning it had already attracted depreciation to a tune of 50,000 accumulated in nature. If we trade and incur depreciation of 28, it means the accumulated increases by 28 to 78, and the net book value reduces by 28 to 202. Same thing on computers. They were bought at 20,000, but had a net book value of 12 by the time of starting business this year. And now it means that if we have also incurred depreciation at 20, I mean at, was it 70,000? I mean 2,000. So the accumulated goes to 10 and the net book goes to 10. Here it will be, we bought at 20. We bought at 20. Accumulated is 10, including current year depreciation, then the net book should be 10 as well. So when you total up this, the total assets at cost, and then the total depreciation accumulated, and then the total carrying values, this will be the figures, totals for each category. And you might desire to, I think, first put that line up there. Then you come and put current assets.
Excuse me, sir.
Yes.
I think you're not sharing the very screen you are teaching.
Sorry?
I'm saying I'm not seeing the very screen you are talking about. Yes, thank you.
So now current assets, we are going to start with the inventory, but this inventory is into 3. The first one is the inventory of raw materials, which is going to be which figure? Then inventory of finished goods, and then inventory of work in progress. That is WIP. So finished good, raw materials amount to how much? Raw materials, if you went to here, we are looking at closing values.
It's 24,000.
Closing values, yes, raw materials amount to 24,000. 24,000. What about finished goods?
40,000.
Finished goods.
40.
Finished goods, we have it at 40. Then the other one should be what? Work in progress closing is how much? I think this was 15.
15,000.
Not so?
Yes. Yes, sir.
Sorry?
Yes, sir.
Then what else do we have to add here apart from inventory?
Accounts receivables.
We have accounts receivable. How much? How much?
142,300.
Yeah, when you go to the trial balance, this figure is there as 142,000. 142,300. What else? What else do we have as a current asset? current asset. Please, we have bank and we have cash. Okay. We have bank. Bank is how much?
Bank is 16,800.
16,800. Then cash.
1,500.
So what is the total if we totaled? Realize that now if we total all our current assets, we are going to have a total of how much? 239,600. 239,600 if you totaled 600. So these are the total current assets. I don't know whether we've left anything. That means that the total assets will be total non-current at net book value plus the total current, which is now 400 and it's going to be 400 so these are total assets. Please try to see that we have not omitted any information because we might leave out something and then along the way we hit a snag. So try to ensure that we've left nothing unattended to. So that part of the account is done. We now only need to focus on bringing out the aspect of what? Of the aspect of liabilities, the aspect of capital. So we can do it this way. We now come to add capital and liabilities. So we begin by liabilities. Do we have anything? Liabilities, if they are there, liabilities. I think I saw we had payables somewhere. We had accounts payable somewhere. Yes, 664,000 accounts payable. Have you seen that?
Yes, sir.
Accounts payable. These ones were at 64,000. Make this one also a bit expanded for easy vision. Any other liabilities? I think we have capital. We have the opening capital position. At how much? Opening capital position, as per the information we have, was given to us as I think 357. If we check the question, we have an opening capital of 357. Then we add profit. Add net profit. How much was the profit? We got it from the income statement somewhere here. It is that one. So that our now when we add this capital opening and the profit, we get this figure. Which figure? I saw we have an element of drawings. Can we take them off? Drawings were given as 60,000. If you look at the question very well, the drawings are in there as 60,000. Are we seeing it? Have we seen it drawings?
Yes.
So when you add these two, where are you? You are at that. So now if you have that capital capital plus profit minus drawings, you have a figure of 387,600. Then to get total liabilities and the capital, you add them together. So you will be at that figure. That is what we call total capital. And so you only need to check it to see whether we are balancing, and that will be the day. If we don't balance, we go back and look for the anomaly, but I hope we are balancing. And even if we left it there, we shall have finished it. So unless otherwise, I think that one marks the end of looking at the manufacturing accounts. That is what we are supposed to get out. Okay. So if you have a question, you have to look at it comprehensively like that. And we get to the answer. You don't have to panic. You simply take your time, well coordinated, well calm, and well composed. Then we get there. Can we continue? Someone is going to say no. So, okay, in the interest of time, for today, we can leave it at this point. We are going to meet next week. And as we meet next week,